The Schwab US Dividend Equity ETF has a lot going for it. As we discussed in one of our previous videos, it makes for a tremendous long-term passive income snowball machine. That being said, there are several headwinds emerging for the fund that investors need to be aware of. And so in today's video, I'm going to discuss those. Hey everyone, my name is Samuel Smith. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. I recently launched my YouTube video in order to share my unique approach to dividend investing with a larger audience. So if you could please like this video, subscribe to my channel, and share your thoughts on SCHD in the comment section below, I'd be greatly appreciative. Thank you very much. So the Schwab US Dividend Equity ETF, otherwise known as by its ticker symbol SCHD, does have a lot going for it. And some of the main reasons why many investors like to buy it is that its dividend yield is over 3 times that of the S&P 500s right now. So it makes for a nice form of passive income from a broadly diversified portfolio. It's also one of the lowest cost ETFs in the market today with just a 0.06% annual expense ratio. And this means that you get to keep a lot more of your earnings from your investments. And that really can add up over the long term, whereas more expensive funds tend to underperform over the long term, as the asset manager that manages the fund is going to collect a lot more fees from you. Another reason to really like it is it has a very impressive dividend growth track record. It has grown its dividend every year since its launch about 12 years ago, and it's also grown its dividend over the past 10 years at a rate that exceeds 11% per year. A final reason to really like it is that its long-term total return performance is actually pretty good. Until very recently, it was generating total returns that roughly mirrored those of the broader S&P 500 since its inception. And the only reason it's underperformed over the past few years is because it does not have any exposure to the Magnificent Seven stocks, since they have such low dividend yields and SCHD targets larger dividend payers that also grow their dividends at a fairly rapid pace. And so with the AI bonanza going on, the S&P 500, with its large concentration in the Magnificent Seven stocks, has surged ahead of SCHD. However, if the AI bubble were to ever pop, or at least a reversion to the mean were to occur, I think SCHD would likely outperform the S&P 500 and catch up or even surpass it in cumulative total return performance over the long term. So for those reasons, many people do like SCHD. And as you know from my previous video, I do think that it's probably the best all-around dividend growth fund that there is out there, especially if generating a satisfactory current yield is important to you. That being said, there are some negative headwinds that investors need to be aware of. The first big headwind is that inflation, yes, it's starting to come down, but it's still remaining fairly stubbornly high. And the Federal Reserve has made clear that they are in no rush to cut interest rates. Now, they could end up cutting once or even twice later this year, but there's also a growing chance that they're not going to cut more than once or maybe not even at all. And given that SCHD does invest in higher yielding stocks, many of them are considered to be similar to bond proxies. And so when interest rates remain elevated, that keeps their stock price suppressed because the market expects a higher dividend yield from them to compete with the yield being offered by bonds. And so for those reasons, it could mean that even for the next 6-12 months, SCHD may experience suppressed total return performance due to interest rates remaining higher for longer. Another reason to be cautious about SCHD right now is simply the fact that about 40% of its portfolio is invested in either consumer stocks or industrial stocks. And both consumer and industrial stocks tend to be more exposed to economic cycles. And there's growing evidence to suggest that the economy is beginning to slow significantly and potentially even could enter a recession. Reasons for this include recessions in several overseas major trading partners in Europe and East Asia. Also, unemployment has been rising recently, and it's now up to around 4%. Jobs numbers are coming in weaker. Consumer sentiment, consumer spending is weakening. Consumer debt is rising. Corporate debt is rising. Especially in the middle market segment, there's growing distress in that segment as Aris Capital Corporation, a prominent BDC and middle market lender, their CEO recently commented that he expects defaults and non-accruals on their loans to middle market businesses to increase not only in their business, but across the middle market sector this year. And so there are growing indicators that the economy seems to be headed towards recession. And of course, there's also a sharply inverted yield curve, which historically has been an indicator that recession is coming. So if we do get a recession, there's a good chance that a number of SCHD's holdings will be significantly negatively impacted, and therefore the ETF may experience some underperformance. Another reason to be wary of SCHD, at least for the short term, is it has very low exposure to AI stocks. As already mentioned, it has no exposure to the Magnificent Seven, stocks like NVIDIA, Apple, Microsoft, Alphabet, Meta, Amazon, and Tesla. It doesn't hold any of those. And so also it has only about 8% total exposure in its portfolio to the tech industry in general. And so for as long as AI remains in favor and those remain the market-leading stocks, SCHD is likely going to underperform. Another reason to be cautious about the near-term outlook for SCHD is simply the fact that there are soaring geopolitical risks around the world. You have Russia's war in Ukraine that does not seem to be going away anytime soon, and there's always the risk for escalation there. You have the war in the Middle East between Israel and Hamas, and very active Iran that could at any moment explode to a much larger regional conflict. And then, of course, you have East Asia, which is perhaps the biggest powder keg of all. We have North Korea and South Korea with spiraling tensions there. And you have China embroiled in numerous regional conflicts, whether it be with the Philippines or Taiwan, and the threat of war erupting there. And so for all those reasons, the stock market could get hit at any moment if a major geopolitical event were to materialize. And SCHD is not particularly well hedged against this. Yes, they have a near 4% exposure to Lockheed Martin in their portfolio, and as a defense stock, it would likely benefit some from growing tensions or even war breaking out around the world. But at the same time, they have extremely low exposure to precious metals and other sectors that would benefit from spiraling geopolitical conflicts. And so for those reasons, if something like that were to break out, especially involving China, which could disrupt a lot of trade, it would likely hit SCHD quite badly. Then a final reason to be a little bit concerned about SCHD right now is that their dividend growth is slowing. Yes, they have a very impressive dividend track record. And while it has slowed somewhat in recent years, even the last 3 years and even the trailing 12-month dividend growth rates are about 8-9%. So still very strong, still well above inflation. However, if you look at some of their largest holdings, you can see that this is likely going to continue to decline because they're increasingly holding large value stalwart stocks that, yes, they provide a nice yield in the 3 to 5% range, but their growth rates are coming down substantially. For example, they have Verizon in their top 10. Which, yes, it has a nice yield. Yes, it's got a good dividend growth streak, but it's only expected to grow its dividend at about a 1 to 2% annualized rate moving forward due to the heavy competition in its industry. It's become a very low growth sector, has a lot of debt that's having to focus on paying down, and it's really not generating much, if any, organic growth. And so its dividend growth rate is going to be very low. You also have stocks like AbbVie, which is speculative in nature because it's so dependent on its development pipeline through its biotech business. And so it's very hard to project how big of a hit some of these drugs that it's developing will become, if they'll even become a hit at all. And so it's very hard to predict reliable dividend growth. And even analysts there expect a low to mid-single digit dividend growth rate for AbbVie, which is another top 10 stock. Another top 10 stock it holds is UPS. And that's another well-established, moated business that's not going anywhere. It's a great one to have, long-term compounder. But again, it's become a slower growth stock. And analysts are only expecting low, maybe 3, 4%, 2% annualized dividend growth for that stock. Then, of course, you also have Coca-Cola, which is another Warren Buffett dividend growth stock, blue chip, phenomenal company. But their dividend growth rate's likely only going to be about 4%, at most 5% moving forward. These are all the top 10. They have others like them that are going to be just gradually slowing down the dividend growth. So as an investor in SCHD, yes, you get that pretty solid 3.7% trailing 12-month dividend yield. Looking forward, it's probably going to be closer to 4%. Comfortably exceeds S&P 500 by 3 times or more. Good source of current income. Yes, the dividend growth is likely going to continue to exceed inflation for years to come, but investors need to realize that when they're signing up for SCHD, they're likely not going to see that 10% plus dividend CAGR moving forward. They're probably going to see something that starts in the high single digits and is going to slow gradually down to probably more the mid single digits. This will be especially true if we face an economic downturn. So for those reasons, I continue to like SCHD a lot. I think it's a great plug-and-play, one-size-fits-all solution for investors who want to combine attractive current income with inflation-beating dividend growth with relatively low risk and low expense fees for the long term. And I think SCHD has a pretty good chance at outperforming the S&P 500 over the next 5 or even 10 years because I do think the mega-cap tech stocks are likely overvalued. And yes, they'll continue to generate value in the long term because they're great companies. AI is not going away. But I think so much of that has already been priced in that they're likely going to face much lower returns moving forward, and that will give SCHD a good chance to catch up. That being said, investors need to be clear-eyed about these headwinds coming their way, and if they're looking to make a ton of money over the next 6-12 months, SCHD would not be my pick. I would say SCHD is much more for long-term income, patient investors. If you enjoyed this video, helped you on your dividend journey in some way, please give this video a like, subscribe to my channel, and share with me in the comments below how it helped you, or maybe you didn't like the video and tell me why and how we can add more value in future videos. Thank you very much. See you next time.